Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets. Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. Thanks for being patient with me as I've had a little bit of computer problems. We're going to re-record our video. We lost yesterday's footage, which is really tough, but that's okay. I love doing this stuff for you guys and for our clients, and so here we go. In this week's episode, we're going to address the Bank of Canada's most recent monetary policy decision to leave the overnight target rate unchanged. We think, for now, it remains the right call. We'll also take some time this week to address some of the criticism the BOC has received for its reluctance to cut more aggressively and why those comments are both misguided and unbecoming of a senior political official in a developed economy. First, the rate decision. The BOC left its target for the overnight rate unchanged at 2.75. Their stated rationale was that despite high levels of uncertainty regarding trade war and tariffs, the Canadian economy is showing some resilience and critically is suffering from ongoing pressures with underlying inflation. The latter point is something that we flagged many months ago and something we will continue to keep a keen eye on. We don't think the inflation problem is over or has gone away, and neither does the BOC's governing council. However, the BOC did hint that they would be ready to cut if, and I quote, a weakening economy puts further downward pressure on inflation. To be clear, absolutely nobody should have been surprised about the Bank of Canada's decision. This no cut has long since been priced into the overnight index swap curve, where market participants can essentially bet against certain outcomes and hedge their interest rate exposure. Virtually all developed countries have a similar market. Some are bigger and deeper than others, but they all have them. And although there are some times where the ultra-low probability event does sideswipe the market, there was no evidence that this might happen last week, as we got closer and closer to the day. Something else to consider when thinking about interest rate expectations and central bank policy decisions is the yield curve, or in very simple terms, interest rates at different maturities. Each maturity reflects a different investor appetite and tells us different things about the expectations for an economy. Again, very simply, the front or short end of the curve is basically monetary policy, and the long end of the curve is about growth, inflation, credit quality, and a couple of other factors, but we'll leave those out for now. The Canadian yield curve has been shifting upwards for months. This is naturally mimicking the overnight index swap market and telling us a rate cut was unlikely. So quickly, why is the BOC so concerned about inflation if the tariff impacts have been muted? As discussed in episode 46, the BOC's three preferred measures of inflation have been rising for months now after bottoming late last year. And this was reflected in the strong inflation breadth measure that's highlighted in the Monetary Policy Report in July 2025. This means that although headline inflation has been relatively well behaved, under the hood, there's a growing number of CPI components that are rising. So now that we know why the BOC didn't cut, let's address the criticism and why we think this is neither helpful nor economically sound. In case you haven't heard, Doug Ford, the Premier of Ontario, is the specific criticism that I'm referring to. And he said that he was shocked that the BOC didn't cut rates, that Canada was suffering from tariffs and needed lower rates to save the economy. Premier Ford should know better. Firstly, I've demonstrated to you that no one should have been shocked. And secondly, there's a good reason the BOC is meant to be independent, and his comment is a proof of why. No politician ever wants interest rates to go up and stay up. This is because they largely abhor any fiscal discipline, and in Mr. Ford's case, are focused on the rising credit and housing bubble that has helped his economy and allowed him to remain in office, rather than make the hard choices towards sustainable, long-term growth via improvements in productivity. Normally, this type of meddling is reserved for banana republics and dictators, and the examples are too numerous to count, but whenever politicians get involved with setting interest rates, bad things happen to inflation, currencies, and credit quality of key financial instruments. America be warned. In episode 48, we discussed how Canada is facing a productivity emergency. There's not been enough CapEx from the private sector, and our top line GDP growth has been fake, so to speak. It's been driven by mass immigration. And this has hidden the ugly truth that there's been zero productivity growth for the better part of a decade. With rising inflation and global yield curves pushing interest costs at home and abroad higher, the other growth driver, a private credit sector binge, is also fizzling out. And rest assured, the big, beautiful deficit Canada is about to get hit with is not helping either. Ford should be directing his vitriol towards the federal government and its plans to blow out this year's budget, $90 billion and counting. This means more bonds issued. That means more supply. And without sufficient demand to absorb those bonds, this means prices fall and yields rise. Such is bond math. We'll touch on that over the next couple of months, I'm sure. The big picture is that Canada is one of the most indebted countries in the world. And even more debt, driven by lower interest rates, is the last thing that Canada needs. If you remember, in last week's episode, our record on capital investment is horrible. And real estate speculation has been partly to blame. And seemingly all Mr. Ford cares about, and most importantly, is not going to solve our productivity problems and get Canada out of what is a really big economic malaise. Finally, my hope is that the BOC resists the urge to lower interest rates below the rate of inflation, i.e. keep real rates positive. I think that this is where Canada's monetary policy went wrong, and you can see that in red on the chart before you. By, in effect, providing free money, it disincentivized investment in more productive assets, fueling a housing bubble, and siphoning capital away from non-residential capital investment. All right, that's a wrap for this week's episode. Again, I'm sorry I was late. Hopefully you'll forgive the snafu. Please like, subscribe, and follow for more. Every Thursday, we talk about the Canadian economy and how it affects Canadians and Canadian investors. We manage money for families all across Canada and the world, so please feel free to get in touch.